Good morning, Sense of Things audience. It's Jeff and Ron here. We are kicking off another week and lots of news. We've got some news today about the world's deepest hole, and we'll be talking a little bit about what's going on with the stock market again. We'll have a little bit of an update on the fear and greed index. And we're going to finish off with an interesting trend that we're seeing happening in the 401k space. And we'll just discuss that a little bit. Ron, good morning, sir. How are you?
Good morning. Mid-August, never a dull moment. There's still news, even though half of Wall Street's on vacation.
Half of Wall Street and our president are on vacation. So yeah, everybody's out.
So's Congress, right?
I know. Yeah, everybody.
Nothing's getting done.
Yeah, actually, the best part about it is there's no government working. So actually nothing gets done and life is good.
All the news programs, really entertainment TV sprinkled with news,
Yes,
are having their field days now because now they can talk about whatever they want because there's nothing to counterpoint whatever they're saying.
that's exactly right. And there's no actual no proof of what's going on at all at this point, or no, they can create their own news, which I love.
Oh,
Cool. I wanted to kick us off today with an interesting story. I just bumbled across this, and it was one of those things that you just can't stop reading once you start reading it.
Yeah.
The world's deepest hole in the ground, which I wasn't even aware existed, just actually ceased. There has been a battle going on between us and the Russians since 1957 to see who could dig towards the core of the earth and discover scientific secrets. And so this interesting thing, this is actually not the hole. This is the funny part is this is actually not the hole. Yeah, but somebody put this in there. Yeah, somebody put this in the article so people would think. Now, this thing is actually only 9 inches across. So 9 feet across. So this is actually what it is. It's out in the middle of nowhere out in Russia. They started
most
drilling.
of Russia out in the middle of nowhere anyway.
Yeah, 90% of Russia is nothing in the middle of nowhere. But this is literally in the middle of nowhere, in the middle of nowhere out there. And they started this thing. It's 9 feet across. They started digging this thing in 1970. So the whole thing, as I read this article, and I'll put the link to this article in because if you're as weird as I am, you'll actually start to do this. The United States actually started in 1957 digging a hole off the coast of Guadalupe Island in Mexico, which, if you know anything about that part of the Baja Peninsula, that's the deepest part of the ocean off the coast of Mexico. And so they started digging this thing because they wanted to reach the Earth's mantle. And in I think it was 1970, Congress pulled funding for this thing, so it stopped. But the Russians at the same time were doing this, and they started building this Kola project, Kola project in the Kola Peninsula of Russia. Started digging this thing down. They created this insanely big rig that they started digging this thing, and it literally is 9 feet across. The drill head got down by 1974, they got down to 15,000 feet. Back in the United States, there's a group, Lone Star Producing Company, that actually dug the deepest hole in the United States in the same time period. And then this thing blew through. Ours in the United States was 31,400 feet. But this guy by 1979 was at 39,000 feet, or by 83 had reached 39,000 feet. And then they started to slow down, but they've recently gotten it as far down as 49,000 feet and started to see the temperatures rise massively at that point. And so they couldn't drill anymore. But I thought the interesting thing was one of the things that they dug out of this was this fossil, which it's the deepest found fossil ever in history at 49,000 feet. So basically they drilled half the way into the earth, almost and drilling to inside the earth is actually farther than it takes to get to space if we tried to get to the Earth's core. But yeah, they were finding these weird fossils all the way down at 49,000 feet. So they're like 2 billion-year-old fossils.
I only have one beef with this article. Now, this is somewhat interesting, somewhat sad too, if you think about the spending of government money for something like this. You think, where does this article belong? A science site, something like that?
Yeah.
Scroll all the way up to the top. Look
Yeah.
at the source of this article.
Greedyfinance.com. I think this is
No.
hilarious.
That's the name of the website.
Yeah.
But look at the source of this article and right underneath the headline. No. Okay, there it is. You just saw it. Scroll down a little bit. Keep going. Maternity week.
Yeah. And I think this is the
Is there a
source for
correlation
this
here?
picture is maternity week. And I'm like, what the hell does this have to do with maternity week? I have no idea.
Listen, I'm sure some comedians could come up with a couple of good jokes there, but anyway,
That's just, it was one of those ones that you just start reading and you can't stop. And of course it's got like ginormous amounts of Google ads all over the page, but yeah, it's just so funny. I'm like, why? What was the purpose for this? And why did you keep going for almost 40, almost 50 years at this point?
I don't know. You want to talk about ad placement or whatever. As a quick side note, I remember watching, because I'm a big hockey guy, watching hockey in the Olympics. Now think about it. Who is the predominant audience that is watching hockey, period? It's a male audience.
You would think.
Yeah. About every other commercial break, there were commercials for feminine hygiene products. Now, I don't understand who the producers are, who the sponsors are. Obviously, you want your product and commercial to go out to your broadest audience.
Mm-hmm.
Sometimes you just can't figure these things out. So maybe I got to reach out to maternity week for my science news.
For your science news going forward. Apparently they are on this news pretty well. But yeah, like I said, the world's deepest hole is now stopped and there's just no need. They've discovered after almost 50 years that there was no need to dig any deeper, and
our lives can go on.
Our lives can go on. The US wised up a long time ago and said, why are we doing this? This is completely stupid.
Yeah, I hear. All right, so let's turn to some economic news. I had a very spirited conversation with a friend of mine the other night, and looking at bond yields, specifically the 10-year. It just breached 430 this morning, and they were talking about if it breaches 4, if it gets to 420, 425, we're above 4.3.
Yep.
Now, I'm not sure, how to talk to prospective clients, but many pre-retirees and retirees that I talk to, whenever they talk about how much income can I expect from my portfolio,
sure,
and we give our typical response because we can. Look, we can get you a minimum of 5% yield annually, pretty conservatively, very low risk, low volatility, get you 5% annually without touching principal.
Yeah.
So think about this for a sec. I expect a rate hike in September, maybe not November, but if it's not September, it'll be November. I'm looking at one more. With the direction things are going, since the July hike, we'll probably get close to, if not breach, the 5% on the 10-year. So think about it. If somebody's a pre-retiree or retiree, and they're like, risk-free, I can get 5% on my money for 10 years and sleep like a baby at night, how much money is going to get pulled out of the equity market and go into the 10-year note?
Sure.
A lot. And I'm not just talking about our clients, prospective clients, US citizens. How about China, the European countries? Japan's 10-year, I just saw this, it's 0.4%. Oh, it's under 1, I know that.
Yeah.
I should have the stat in order for this, but aren't these countries going to start gobbling up the 10-year at 0.3 or 5% or more? So if that doesn't seem like a bit of a short to medium ominous sign for the equity markets, if those yields continue to rise and people could lock in 4.5%, 5+% and sleep like a baby for 10 years, seems pretty obvious to me. I don't know how you feel about that.
It ends up being supply and demand too. So if we see a huge rush of external money in, it's supply and demand. So the price of bonds would go up at that point too, in a lot of cases, or it'll stabilize and won't continue to go up. But yeah, I'm looking at this with my clients at this point. Certainly, you still have to have something in there that can beat inflation, because yes, most of the models are built on inflation at 2.75 to 3%. We're still running close to 4.5%, 5% on inflation. I think, yeah, I can get a riskless rate of return at 5%, but if I'm inflating at 5% per year, it's not really truly netting me 5%.
You're also not locking up all your money.
Yeah.
But you may take, again, a pre-retiree or retiree may lock up 20 to 50% of their money in there.
Yeah.
And the rest of it, yeah, okay, they could be a conservative risk if they want to get yield and still grow it. But you're right, asset prices would go up, yield prices would come down. But wouldn't that be the same for all the T-bills that are under 1 year that are all yielding better than 5.2, 5.3?
Yeah.
The yields just continue to go up. People are piling in to the short-term T-bills, but the yields are still going up, which means the asset prices are coming down, even though people are buying them.
Yeah.
So the logic, I understand your logic, but if the yields continue to go up, people are going to shift their money from equities to bonds. There's just there's no other rhyme or reason to it.
Yeah, we've talked about this before. The bond guys are typically the smartest guys in the room. They're the most boring guys in the room, but they're typically the smartest guys in the room. It's smart money over time. And I agree. I think the weird part about this time has been the bond market has been counteracting a lot of what the Fed is doing and a lot of what the government is doing at this point, almost buoying this stuff up. You would start to see, or you would theorize that you'd start to see interest rates going down, but the government hasn't proven itself to be responsible with money at this point. So I think it's causing those yields to just continue to go up. I'm just wondering, had we not had all this money rush in there, where would the yields be at this point? Would we be in 1980 all over again?
I don't know.
We had so much less government intervention in the markets back in the early 1980s. That's why we saw rates just go through the roof.
Well, for better and for worse, but I know what you're saying. If you really think about it, even with the direction of where the yields are going, we're paying, again, if you look at our national budget, we're spending over $1 trillion a year in interest payments.
Yeah. And it's going to get worse.
It's not going back into our economy. It's not helping infrastructure. It's not helping important government programs. It's not, upgrading your military. This is just interest payments.
Yeah. And it's going to get to the point where it's almost, especially if you don't grow your economy. I mean, we're really slowing down on growing the economy at this point. You don't grow your economy, you're not going to get yourself out of that situation.
No.
Yeah, it's interesting. The 10-2, I was looking at the spread. It's come back pretty significantly on the 2-10.
In the 60 basis point range. I didn't see where it was today.
Yeah, it's 69 basis points right now.
Where
is that 2 to 10 year spread? It's come back. So
yeah, it was 70 something yesterday.
Yeah.
Yeah, so it should be interesting. It looks like a little over 60, but it's very interesting just to see how all this pans out. Like I said, the next 60 to 90 days, you're going to have to make a lot of popcorn because it's going to get interesting.
Yeah. And like I said, I still personally think we're going to see a bit of a rally by the end of the year, but I think 2024 is going to be a pretty hefty slog at this point.
Well, look, with all the credit tightening, it's got to slow down the economy somewhere. People may say no recession. The whole recession thing, you and I have spoken about this. Yeah. I think it's a BS thing anyway, by the way they judge it.
I do agree.
People are hurting. People have less money in their pocket because of what they're paying for gas and food and everything else out there. So all that being said, so even if we don't officially go into a recession, which I still think we will, it doesn't matter. If the market pulls back 10, 15, 20% in the next 6 to 9 months, and officially GDP, we're not in a recession, it doesn't mean that our economy wasn't hurting. And by the time we're already in a recession, we've already felt it. It's always a laggard number two. As a matter of fact, I know I had sent you an article and it had 30 charts that kind of really describe the economy. So I cherry picked, I whittled it down to 3. I think this would be good conversation because with this one here, I thought about the savings rate, and we've talked about how credit card debt just breached a very high number where it's never been in history before,
Mm.
$1 trillion. Now we take, and then the savings rate was dipping down to near an all-time low. Well,
Mhm.
recently savings rates have taken a significant rebound. And the disposable personal income is another thing that a lot of economists like to look at, because obviously with inflation, it's shrinking the disposable income. So
Mhm.
now with people have a little bit more disposable income, they're doing the smart thing. They're actually saving. So if they're saving, that means they're not spending.
Which is
Another
shock,
big
yeah,
one,
which is shocking for this country.
yeah. And another big one, I know that we had talked about this prior, was the rental market. There isn't a lot of inventory, so a lot of the landlords have been raising
Mhm.
rents on the tenants, whether they're existing tenants or not. I heard from people, their kids or whatever, were paying 20% year over year increases on
Mhm.
rents.
Yep.
So I thought this was very interesting that new tenant repeat rent essentially collapsed
Hmm.
from almost 9% down to 2.
Hmm.
Do you see anywhere else in the last 18, 20 years on this particular chart where you had such a precipitous drop? Even during the financial crisis,
Yeah, it dipped off
fairly precipitous
slowly. Yeah.
drop. So I thought this was pretty interesting. And I thought this was my favorite chart. And I actually, when I saw this, I didn't understand it. And I had to look up some things. What this is actually a combination of the GDP and the
Okay.
G and the GDI, the, the,
Okay.
the, the domestic index. And every time it has had a precipitous drop or reached below the 0%, a recession has followed.
Mhm.
And I remember seeing this chart a long time ago and looking at some other things. And you know what? I don't even know how to even create this chart, to be honest with you. Got to find it. But I think these are all telltale factors
Yeah.
about the consumer spending, consumer saving, because if they're saving, they're not spending. But the other thing too is, even though the GDP had a bit of a bump up from last quarter, if people aren't spending, or if spending is
Mhm.
going down, again, they're not borrowing, they can't afford to borrow to keep buying houses that they once were. They're not buying cars, and cars are at a 20 to 30% year over year increase over the last 3 years.
Mhm.
You tell me what you think is going to happen.
I think the only thing that's buoying this up is we still have good employment. As long as we have good employment, people are making do. But one of the things we were going to cover last week, and I wanted to push it to this week, there was an article that came out on CNN Business last week about, it was actually reported from Bank of America, which actually Bank of America owns Merrill Lynch, which is the second tier, I would say, of 401k providers out there. And there was what they called an alarming rate of change in the amount of hardship withdrawals from 401ks.
Yeah,
And you and I both know there's 401k loans, which you can go get a 401k loan for anything. You can use that to go buy
right.
a TV. You can use it to just go blow money at a whatever you want to blow money on, and you have to pay that back out of your paycheck. A hardship withdrawal, you have to have something really dramatic happen to you.
Specific criteria. Yeah.
Yeah. And it's typically things like you've got a lot of medical debt, or you're losing your home, or something along those lines. And the only thing I can say at this point, because I don't think there's a dramatic increase overnight in healthcare related issues. That usually stays pretty steady. The only thing I can attribute some of this to, and I actually went and did a little bit of research on this and found an article from Fidelity, or an article about Fidelity Investments, which is the largest 401k custodian in the world. And they were reporting very similar numbers. The only thing I can attribute that to is housing and the cost of housing, and people getting into trouble there. They've maxed their credit cards out, they've done whatever loans they could do, and now they're down to the point of, I'm going to lose my house, I'm going to be foreclosed on, I need to do a withdrawal from my 401k.
Or medical. That's another big thing, another big
Yeah.
reason why. Again, there's a reason why it's called quote unquote hardship.
Hardship. Yeah.
Yeah, you're right. A loan you could use for anything, But many plans, I know several of our plans don't offer the ability to take loans, but we obviously, you always put in a provision in there for people to be able to offer hardship loans, because if they need the money and there's a hardship, you don't want to deny an employee from being able to take that money for those costs. So you're right. If there's a spike there, plus remember, we were talking about this about a month and a half ago about a spike in small business bankruptcies.
Mhm.
And I saw a couple stats a couple of weeks ago. That hasn't slowed.
Yeah.
Now, I haven't heard any personal things because you and I both have a lot of clients that also are business owners too. I haven't really heard anything from them about their businesses suffering, obviously even being close or teetering on the verge of bankruptcy. But all these undercurrents, I'm not happy about. I know you and I are a bit of an echo chamber at this point of what we see here.
Yeah.
Look, nobody's going to predict the exact date, time, or even really month that a recession is going to happen. We're better off going to the casino and picking black or red to put our money on. But you know what? Like I said, even if we don't, officially have a recession, 2 consecutive quarters of negative growth, it doesn't mean that the underpinnings of credit and things like that aren't going to make people hurt. And like I said, with the yields going up, you're going to see a shift of money going from the equity market to the bond market.
Mm-hmm. Yeah. Yeah, and I think that's true. And once again, one of our things that we cover here on a somewhat regular basis when it reports every month, just this morning at 9 a.m., as we were getting on the air, we saw the report from the leading economic indicators.
Yeah, it came out today for our podcast.
Yeah, it's awesome. It's perfect timing on this. I think the interesting thing has been that we've seen GDP tail upward a little bit, and we've seen a little bit of a turn on the leading economic indicators, but they are still dramatically down below that zero line. Anything that you say that, okay, it's getting better or it's looking better, it's still really deep into this. And anything that would happen, you see this happen quite often with the back in 08. In 07, it started to tail off, and then it finally dipped, and that indicated a recession there. Doesn't always have to go negative on the GDP side, but typically when you see a pronounced drop down in the leading economic indicators for a period of time, it does indicate a recession. And like I said, I think it's in here someplace. I just don't know when it's going to happen, but it's in here someplace that we're likely to see a recession coming up. How does that affect the stock market? The stock market tends to lead ahead. So that might mean that we squeak our way through the end of this year, but I have a pretty pronounced feeling that 2024 is not going to be one of the greatest years out there.
Two quick things about this. So the GDP is a one economic factor.
Yeah.
Right. And actually, if you talk to a lot of economists, it's an antiquated formula that they use, which is why when the GDP report comes out, yes, they focus on the large number, but they break it up into key components because, they're cherry picking, but they're picking it out. But the LEI is a combination of many different factors. Actually, just scroll up for a second.
Yeah, I just did right here.
Because with the GDP, scroll up to the main chart again, because I just want to mention something about the GDP.
Yep.
I realize this only goes back 23 years, but when GDP went negative, right? Think about what happened in those two things. It wasn't like a normal garden variety recession. Those were crisis events, which is why the GDP went negative. So the GDP doesn't always have to go negative to be in a recession.
And actually almost rarely does it go completely negative. It went negative in 08 because the whole financial system blew up overnight. You look at the 01, this is, September 11th and all that stuff. GDP didn't go negative. It just hit the line and then bounced off. But LEI
but a lot of that was the .com blow up too, before we got to 9/11.
Yeah.
So we were already on a downslide. And you would think after 9/11, following the bust, you would have thought we would have gone negative.
Yeah.
But obviously you can see for a year and a half to 2 years, GDP was negative for multiple quarters anyway. So again, it's not necessarily about GDP being being negative. It's just negative quarters by the way the economists do it. But even, like I said, it had to go into the negatives in a crisis situation. So the LEI, in my opinion, is just a more comprehensive indicator because of all the different factors it takes. And I
Yeah,
know
here's basically the components. There's financial components and non-financial, everything from the leading credit index, S&P index, stock prices, interest rate spreads. It shows you that the non-financials, it's ISM index of new orders, building permits, average weekly hours. It's a very comprehensive look at what's going on in the economy.
I thought one of the other interesting things I've heard the people, some of the analysts that I follow, take a look at the third one down in financial components, interest rate spread, 10-year T-bonds less Fed rates.
Mm-hmm.
This is talking about the risk-free reward of going into T-bond, T-bill, 10-year T-bonds versus where the Fed rate is. Because obviously if the Fed rate goes up, the 10-year is going to go up too. But the spread on that is almost a full basis point.
Yeah. And that's over 6 months. The July one. Once again, and it's been the same thing. I think the first two non-financial components, the customer expectation of business conditions and the ISM index of new orders. Interestingly enough, consumer expectations, that's everything from business owners to consumers. And then you've got index of new orders. Those are side by side with each other, not just in the chart, but also side by side. If the consumer and business owners are starting to look at, I'm not so comfortable, those business owners that are suppliers and manufacturers, they're going to start seeing their orders pulled back. And I think that's been confirmed at this point. Yeah.
I hear you. Look, I think we might need to do a deeper dive into this next week.
Yeah. And like I said, the only thing that's even remotely close to positive is building permits for private housing. And that's just because we're so underbuilt at this point.
Well, not only that too, but there's been a housing slump in the last year, even though the new home builders have been flying in the first 6 to 7 months of this year. All their stocks have done very well. But again, with building permits, look, it eventually was going to have to take a bump up because we're never going to stop building.
Yeah, well, and they had pulled back pretty much from the pandemic through last year. They had really pulled back. And of course, they were selling like hotcakes. But then last year, when interest rates really went up, building stopped. I think one of the things I heard this morning was, all these companies are flying now because they're actually going in and doing things like taking some of their profits and buying down rates on mortgage loans and everything else. So people are out there trying to buy new homes versus existing homes because of that.
Yeah. You know what? Until next week, let's see how the LEI gets digested today and tomorrow. We're almost at the end of earnings season and getting towards Labor Day. So that I know out here in Arizona, and I believe in Texas too, kids have already started to go back to school. So towards, in the next couple of weeks, it's going to get slower in the markets, which means we'll probably see more volatility. So
typically, you've got the Northeast that are finishing up their vacations at this point. I think we'll get into September. We're only 2 weeks out at this point, get into September. Hopefully for you and I, it won't be 5,000 degrees until November this year. And we get on to some cooler weather. We had one little spike down yesterday, and I walked outside and it was 75 degrees and it felt like, oh my God, I need to put jeans on instead of shorts today. So,
get a winter jacket out.
Just get a little light jacket. But it was fine. And then this morning it's 85 degrees when I got up. So much for that idea.
I hear you.
But I think a lot of interesting stuff going on. I think there's going to be a lot for us to talk about over the next few months as we get in. Of course, we're swinging into presidential and election season. Pretty much starts up in September. A lot of what's going on. There's going to be a lot of talk out there, and it always gets interesting in a presidential election year. So next year is going to be a lot to talk about there as well. And I think for everybody that's out there listening, do I think that we're at the end of the game? I personally think we've still got a little bit of a short run, but I think it's coming to reckoning with a lot of this stuff. And that piece that I talked about on hardship withdrawals, that's just the beginnings, I think, of something.
As just a quick note and planting a seed for our next couple of podcasts, Fitch came out earlier this week talking about there probably will be downgrades of some of the major banks
Yeah.
in their ratings.
Mhm.
Not the small regional banks, the
Mhm.
big banks.
Yeah.
How is that going to take effect too?
When you think about, we're talking about interest rates, and even if rates are going up, all those portfolios that banks have, they're having to mark those to market, and the prices are much less. And so it puts a big effect on the banks.
Yeah.
So
Well,
good.
like I said, we'll have to see how things pan out here. Again, it's slow news August, but
Mhm.
maybe that's the time they want to announce some of these major things before September. We'll see. We'll
Yeah.
see.
We'll see. Congress gets back into messing things on. They get back into the office starting after Labor Day. So we'll see what goes on there. Folks, we do these every week for for you and you only. Want to help you understand what's going on and our views and what we're seeing out in the markets and how we determine that. Certainly, we would love a little bit of feedback on your side. So if you want to let us know you exist, hit that little up like button on YouTube. That's the little thumbs up button, and let us know you're out there. In addition to that, if you haven't already, subscribe to the channel so that you make sure you see all these coming out. I will be putting another video up today as well as this one. If you missed a show that we did 2 weeks ago, we talked a little bit about Roth IRAs, and that's going to be a component of the show coming up, as we're going to talk about some of these financial planning concepts and things like that going forward. So make sure you subscribe, because we'll be pulling those out. If you miss a show, you'll be seeing some of those pieces of the shows later on as well. So thanks all. Ron, thank you, my friend.
Till next week.
Yes. And we'll see you guys when we get back here the very next time.